You know what it is. That's right. It's time to talk money with your money nerd and financial coach. Now, tighten those purse strings and open those ears. It's the Money Talk with Tiff podcast.
Hey everyone, I am so excited because I have Thomas Blottenberger on the line, and he's here to talk to us about the science behind a good investment portfolio. So hey Thomas, how are you?
Hey Tiff, thanks for having me.
Yes, thank you for coming on. And before we hit record, we had a quick conversation and we talked about how, we always talk about the mindset behind investing and all of that, but we never talk about what goes into making an investment portfolio. So that's what we're here for today.
Yeah, I love it. The first person that's actually asked me about it. Let's do it.
Right. So let's jump right in. So first and foremost, let's start with what is an investment portfolio?
The investment portfolio is something that your money is put to work in that has the potential of loss. That's the easiest definition. So like if I have my money in the bank in a CD, it's not technically an investment portfolio because I'm just making what the bank can pay off of my principal, but there's no real chance for additional gains, additional revenue, additional growth. Also, no chance for loss, though. So in this case, we're talking about very particularly when we talk about the science of investing, we're talking about stocks and bond portfolios. There isn't enough data on some of the newer flashy stuff like, crypto and NFTs and some of the commodity marketplaces and some of the different kind of credit swaps and things that they're doing. There's not enough data out there to validate that it's actually scientifically derived or has what's called a risk premium in it. For the most part, they're just speculative gambles, and that's not scientific.
Right. So we know that we're talking about stocks and bonds. I'm glad we laid that groundwork. So just in case people are here, crypto bros and all of that, they know that this is not for them. No, I'm just kidding. But
well, it could still be for crypto bros because the most important thing to distinguish, right? Like the most important thing for anybody out there to start to look at is to notice what's not science. And if you ask people most people have heard of some kind of investment, crypto or individual stock like Tesla or something like that. And when you ask people, hey, why are you investing in that? Usually what you'll get is a really good story, something that's compelling as a story, but not scientific evidence, right? Like if whether it's Bitcoin or let's use Tesla so I don't piss off the crypto bros, right? Let's say, why are you investing in Tesla? Oh, I'm investing in Tesla because Elon's a visionary and he's going to take us to Mars, and look at all these successful businesses he's already, created. Look at, he's got X now, and he's got SpaceX, and he's got, there's just then Tesla, and there's just all these different, like he's really on the cutting edge of things. And I see it going up from here. All right, cool. Well, that's already all in the price. All that stuff that's already happened is already factored into the current price. That's why it's trading at what it's trading at. That has no bearing on what the future value of it will be. So it's just a speculative guess based on a story. And for most people, if they start to look at why they own what they own, it's generally going to be a really good story and not real science.
Yeah. And, even that we're saying the science of investing, usually we get so caught up on the emotional side. I know I've talked about that a ton on the podcast, but even talking about the science, I don't think gets enough play. So let's hop into the science. What's one thing that people should know as they're constructing their portfolios?
So real quick with what you said about the psychology piece of it, why that psychology piece is so important is because without that, you won't stay disciplined to a scientific portfolio. You'll get the squirrel, right? The shiny object syndrome. And if you don't know how to master your own mind, then the best portfolio on the planet will do nothing for you because you'll find a way to blow it up. So that's the first thing.
No, that's real.
The second piece, okay, so some aspect of science. There's a multitude of Nobel Prize winning investing principles that we use and that we teach people. And they're not secret, so I'll tell you. There's three in particular that we use when we construct a portfolio. There's something called efficient market hypothesis. There's another one called the three-factor model. And then there's one called modern portfolio theory. And all of this is just based off of economic truths, economic science that we can see based on human interactions, right? So let's take the first one, the efficient market hypothesis. Of all of them, the other ones are incredibly technical, really difficult, to understand and to research. But the first one's pretty simple conceptually. Do we believe that markets, right, people buying and selling in aggregate, because that's all a market is. So if we're looking at the stock market is the buying and selling actions in aggregate of all the people who are owning and selling these ownership shares in companies, right? So the main question is, do we believe that people buying and selling and interacting together creates an efficient pricing model? And for the most part, the answer to that is evident, that of course it does. If we look at any area of, if we take it away from the stock market for a second, we just look at big screen TVs. What's happened over time with big screen TVs? They've gotten bigger, better technology, lower price. Therefore, the pricing model of all these people buying and selling in aggregate increases competition, increases innovation, increases validity of these products. It's no different than how it works in the stock market. So if I believe, here's the fun place of this and the point of the efficient market hypothesis, if I believe that markets are efficient, it means that there's no way for me as an individual to presuppose or to guess or predict consistently what the buying and selling decisions of all the other people involved are going to be that's going to impact the price. In other words, it's a fool's game to try to predict the future when you're investing your money. But almost everybody invests their money based off of either your own or your money manager's prediction of the future. And so just off of that basis, it's a flawed system to begin with.
Right. And it reminds me of supply and demand, right? So if a lot of people are buying something, of course, the price is going to go up. If they're dumping it, then of course it's going to go down. And the market just keeps everything efficient because people aren't going to buy it if it's costs more than what they think it's worth.
Bingo.
Does that sound right? Okay.
Yeah. No, it's a perfectly laid out. This is why I started with this one, right? Because it's the most you can just go, oh yeah, that based on the laws of supply and demand, that makes complete sense, right? Why does take a Louis Vuitton, right? Which is a high end, you can just go buy a random bag or you can buy a Louis Vuitton. Well, why is it that they've been consistently having the ability to keep their price points the way that they are? Well, it's because obviously supply and demand have been built into that price point. Mm-hmm. Otherwise, they would have gone out of business, right? So you can look at that and go, well, why are people doing that? That's way too expensive for a bag. Well, clearly a bunch of people disagree with you. And that's the biggest problem with investing also, is not realizing that our point of view is our point of view. The market's going to dictate what actually happens.
Right. And so we might have people wondering, since you said that, so who controls the market? How does the market get to where it is?
It's a good question. So in the simplest way to answer that is, it's the people buying and selling are ultimately the ones who control the marketplace. And what I mean by that is, let's take real estate, for example. Oh, actually, no, let's use Louis Vuitton. Louis Vuitton was a great example. So if everybody who was buying Louis Vuitton bags stopped buying them, what happens to Louis Vuitton?
It goes down in price.
Well, eventually the company would go out of business, right?
And go out of business.
Uh-huh. Unless they innovated or created something new that people wanted to buy. So that's what's, again, really interesting in the capitalist system, is the way the laws of supply and demand work are, if you and other people are willing to use your resources for something, then that thing generally will keep existing. And so same thing with the stock market here, is it's a function of all these people buying and selling ownership in companies. It's the aggregate total of all these people that control the markets. So perfect example, you can see this, right? 2008, a bunch of people got panicked and they sold. They went to cash. They're like, I don't want to be in the stock market anymore. It's too scary. I don't know what the future looks like. And a bunch of people sold out. What happened? Well, subsequently prices dropped significantly on all these companies, right? Where they're some of them 40, 50, 60% loss of value of the stock, given the selling actions of a bunch of people at once. That's another reason why mindset becomes really powerful, because the more disciplined the investor base is, this is a long shot, like human nature will probably never allow this one to happen, but the more disciplined people are, like imagine you had 300 million people in America disciplined in how they were managing their investing and managing their stock portfolios. We wouldn't have those kind of crashes. That's how efficient markets are.
Gotcha. So really they self-govern themselves as long as people don't act out of the ordinary, it sounds like.
Well, here's how efficient and effective they are. They self-govern even when people act out of the ordinary, because when someone panics, that's not out of the ordinary. That's a perfectly rational survival instinct for a human. So it even works effectively in that capacity, right? So bringing it back to a science piece here, right, is how would someone use what I just said? Because that's ultimately, I think, what's most valuable. Great, we just talked about markets being efficient. Sure, let's say I believe that. Well, great, what does that do for me? It's to start looking at, are you basing your investments or your future desired investments based off of the truth that markets are efficient? Or are you trying to predict the future based on a story, which is ultimately saying that you have better information than other people, right? If I own Tesla because I think that the future is going to be better for Tesla, that's a gamble that requires that the majority of other people buying and selling agree with me. That's a flawed strategy right off the bat. You might get lucky, but that's really no different than going to Vegas and playing on a craps table.
Right. That is so true. So as a professional, like if we have people listening and they're like, okay, I get it, I need to incorporate science, like where do they even start with that?
Man, good question. Well, so again, the first piece is being aware that it exists, because most people aren't even aware it exists. And so they're just kind of blindly following. They're either ostriching, they're not participating at all, or they're blindly trusting whoever is telling them what they should do, right? They'll watch the news, watch Jim Cramer, or talk to their financial advisor, and their financial advisor will say, this is a tough election season. I think it might be prudent if we move to cash. And they go, okay, sure, because I don't know any better, right? If that's what you're telling me to do, let's do that. So the most important thing that they can do is realize that there is a science. And if you are working with someone, question them about it. Hey, I learned that there's actually an economic science of how you invest money. What kind of scientific principles do we use in our portfolio management? What science did you use to determine how my investments are set up? What principles did you apply to decide what I own? And that will be very quickly evident if they know that there's science or not, because someone who designed it scientifically won't stutter, won't have a difficulty answering that question. Someone who just sold a product is going to have a heck of a time trying to answer that question.
Very, very true. Very true. So in a nutshell, y'all, make sure if you do have someone helping you, that you're able to ask these questions and get legit answers as to why they're investing in whatever it is that they're investing in.
Well, and there's one other really important key to this, given what you said, that most of the time you're having conversations about psychology. It's like, if they go hand in hand, if I have the right mindset in my life, I discover how to go from scarcity to abundance, and I have power in my life. And then I put my resources to play in a Bernie Madoff scheme and I lose it all. well, let's say I still had the abundance mindset. Well, but now I have a diminished capacity to make a difference in life, in my own and others, as a function of not understanding that what Bernie was doing was a gamble and it was an actual fraud. Whereas if there was some level of understanding that there's a science to this, people could have caught that in advance and not done that with their money.
Absolutely. Absolutely. Well, Thomas, we are at time, and I know we have so much more to cover. We only hit on one science.
Hey, listen, Tiff, if you want to have me back for like a series, I won't say no.
Right. Right. 3-part series on the science. But thank you so much for coming on. And if people were interested in learning more about you or more about the science of investing, how could they find you?
That's a great question. If they want to know more about me, I'm like a really personable dude. I don't know if you've noticed that. They can just follow me on or find me on any of the social medias. I mean, the nice part about having the name Blottenberger is that it's not hard to find me. And then as far as learning more about the science, we actually have a 2-day course designed to help people discover their purpose around money and align that purpose with this science so that they can basically never be duped again. They can meet with any financial advisor and be able to understand what's being said to them and not, just have to blindly follow and hope it works out. And we have a link for that. And that link is Paradigm Shift, PARADIGM shift dot A as in alpha, D as in delta, X as in X-ray, leader.com. So paradigmshift.adxleader.com. And I have a whole section on that website about the American Dream Experience, which is our 2-day event. And if someone's interested in actually really diving in, they can sign up. They can say, yes, I want to attend. And it'll prompt a conversation.
Gotcha. Well, thank you so much, Thomas. And I'll make sure I have all of those links in the show notes, including Thomas's last name spelling. So that way you can follow him on social. But thank you so much again for coming on the show. And we appreciate you helping us out.
Well, thanks for having me. This has been fun.
All right. Bye.
Thank you for listening, joining, and being a part of the Money Talk with Tiff podcast this week. You can check Tiff out every Thursday for a new Money Talk podcast. But if you just can't wait until next week, you can listen to previous podcast episodes at moneytalkwitht.com or follow Tiff on all social media platforms at Money Talk with T. Until next time, spend wise by spending less than you make. A word to the money wise is always sufficient.